Welcome to the Treasury Update podcast, presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in.
Welcome to the Treasury Update podcast. I'm Craig Jeffery, your host today. Today, we're talking about contemplating counterparty risk across the organization, and I am joined by Craig Callé. So there's two Craigs on today's podcast. Craig, welcome to the Treasury Update podcast.
Nice to be here.
I think it was 4 or 5 years ago when we did a podcast before, so I'm glad to have you back. You know, our topic is contemplating counterparty risk across the organization. We've had some fun conversations about what that looks like. You know, but as we think about counterparty risk, as we talk about it, as different areas look at it, you know, it's part of a broader focus, and there's multiple areas that do something along the lines of counterparty risk. It looks a little different in different areas. So Treasury tends to focus on banks. Procurement might focus on key suppliers. Credit management on the major customers. Craig, maybe you could start us off with, how do you think about third parties and the risks an organization faces, you know, either individually or broadly, however you look at them?
Sure. Well, I look at counterparty risk as an aspect of what I define as third-party risk management, or TPRM for short. That practice area really had a catalyst in as far back as 2013 with a major security breach at Target Corp. Most companies get attacked directly. This was one of the early cases of a major company getting hacked through a weak third party that was providing HVAC services across stores in North America. So weak backdoor, if you will, through which a hacker was able to tunnel their way all the way up to the point of sale devices where consumers are swiping their credit cards all day long. And so that became a call to action to reevaluate the practices security teams were taking to secure themselves, and developed the need for new technology.
Yeah, that's a pretty interesting case, right? And that's a common attack method, to find a weak entry point. You know, we see that, you know, there's been breaches that have used, you know, the uninterruptible power supplies that are managed, right? Someone gets in there and they use that to compromise an HR system, and then they're off to the races. So that's certainly important. But we're a decade on from there. How has the industry responded to this type of situation?
Well, for one thing, you know, the problem, if anything, has only gotten worse. I mean, today, more than half of all security breaches are attributable to weak third parties. Companies need to do a lot more to get ahead of this problem. As I said before, you know, there's certainly been, you know, a much greater scrutiny of traditional practices, like questionnaires that a customer might send to its vendors, usually based on some IT framework like NIST or COBIT or SANS. That is very time consuming, very thorough, but not enough. And so over the last 10 years, you've seen some new developments, you know, to help lighten the burden through technology. So I'm thinking of a category like cyber risk ratings, a body of work devoted to continuously monitor the third parties that are part of your vendor community. You know, they reach conclusions that are conveyed in easy to follow metrics, much like a FICO score for consumer credit. And it really helps triage the group so you can focus more attention on the more deserving based on the cyber risk rating that's been developed. So that's one area. There are others, but I'll let you react to that.
So are you describing cyber risk ratings as like a general concept and there's specific scores that are out there, or is that an actual score?
There are a number of firms now that scan virtually every company on the planet. They have sinkholes, honeypots, looking for compromised systems. They're determining the state of IT housekeeping at every organization, and they put weightings on these different risk factors and come up with a score. You know, in the case of one, you know, it might be, you know, 300 to 820. Another might be a letter grade A to F, that sort of thing. But,
sure,
you know, very much a quantified approach to risk management, you know, following, you know, a generation of work that was frankly based more on qualitative assessments expressed in traffic lights and heat maps.
Yeah, and you had introduced us to one of those some years back, and we do use one. We won't mention it, but it was very helpful in both our self-assessment as well as Counterparty. So, one of the things on the responses, things have only gotten worse, I think is what you said. We see requirements placed on third parties, as a consulting firm, far less as a researcher, but as a consulting firm, new requirements come to us first from banks, then from non-bank financial institutions, then from the largest multinationals, and then it falls downstream from there. And so when people start first asking about, do you have vulnerability scan? You need to do a vulnerability scan every year. And so when we heard that from one of them, it was optional. This was a long time ago. We're like, we're going to do it every month. And then it was, hey, we'd like a pen test. When one starts asking, it's going to be a requirement very soon. You only have a limited time where you can push these things off when it becomes an idea to a requirement. That's at most 2 years. And then answering and responding to those has become more involved in the community of responding to show that you have a certain level of rigor. And this is more focused on the cyber side, the financial risk side for, as you referred to as TPRM, the third-party risk management. On the credit and the financing side, there's often been scores, and people look those up just to maintain a level. But this growth in cyber's happened.
Now, I'd like to think that every organization would treat strong security and privacy compliance as competitive advantages. I mean, if you can demonstrate that you're a reliable vendor, you're going to get more business. But in reality, regulation has played a really important and valuable role in raising the bar, especially in sectors that you're very familiar with, like banking and financial services, but also in healthcare and the like. And so these days, if you don't know your cyber risk rating, you darn well better should, because a lot of these customers of yours will be looking at that and generate a reputation, or at least you'll have a reputation based on that rating that's out there. But as you mentioned, you're not unaccustomed to penetration tests and the like. You probably should have an audited SOC 2 report and make these artifacts easily available to anyone who asks, so that you can be transparent about the practices that you have in place to ensure that you're a reliable third party.
Craig, as you think about your experiences, both good and bad, do you have a story that probably influenced the most your thinking in this area?
Well, it's really a question of where I have roots in third-party risk. Ironically, despite spending almost a decade now in IT, cybersecurity in particular, my start in the business came in the early 2000s when I was part of the team at Gateway Computer trying to turn around the company. And one of our Asian suppliers went bankrupt. And so the next day I found myself in the CEO's office along with the head of ops and supply chain. We all agreed, this shall never happen again. And so my second shift started at 7 in the evening in Irvine, California, making calls to Asia, trying to get financial statements and ideally projections so that I could model default risk. So when I started with vendor risk management, it was very much from an exclusive financial viability standpoint. As I mentioned earlier, it was really 2013 when Target became the celebrated case of the vulnerabilities associated with weak third parties from a cybersecurity standpoint. And so, we've been talking about the potential for a deep recession now for 3 years. I think the common prognostication today is that we're in a soft landing already. But I had always expected that to generate even greater interest from a third-party risk management standpoint on the financial risk. And it, even after all that time worrying about it, it has never really risen to anywhere near as great a concern that people still have over the cybersecurity posture of their third parties.
I don't know that the audience just listened to our other podcast where you gave some of your background, but I'd love for you to give the elevator, not pitch, but the elevator review of your career, because I think that provides some good context as you talk on the cyber side as well as the finance side?
My career is broken down into three major buckets. The first was as an investment banker at Salomon Brothers, where among other things, I was head of new product development in the capital markets group. The second bucket is CFO or treasurer at a number of public and private companies such as Amazon Digital Media and Books, Crown Court and Seal, Gateway Computer, and others. And then the third bucket is, and most recent, is in technology strategy. The two roles there include Chief Strategy Officer at SHI International. That's the second largest technology value-added reseller in North America. And for the last 8 years, I've been building my own firm that's focused on cybersecurity, GRC, privacy, and ESG.
What's your website?
www.sourcecallé.com. That's SOURCECALLE.com. Thanks for the plug.
Yeah, no worries. Thanks for your background. Before I asked you for that, I was complaining a little bit about the increased requirements around third-party risk management, or just mentioning how much more is involved on it. This creates quite a bit of overhead, especially when there's multiple platforms asking for, have you responded to this particular threat or risk? Provide this report. The same growth on the insurance side, where it was like, we used to have a couple types of insurance policies that were required. Now I think we have to have 7 or 8 for most firms we work with. This creates a bit of overhead for those that are receiving these requests, and it becomes a cost of doing business. It needs to become more efficient. So there's, we're doing the same things for multiple companies, but, what do you see happening here? Do you see that same trend, or maybe some more nuances in that trend? And where do you see us going forward on that?
Well, there's a term for what you're referring to. It's called vendor fatigue, and it comes from the requirements that you described, getting numerous questionnaires, sometimes over 500 questions, many of which look very familiar and similar to ones that they may have already filled out for another customer. And so there is a lot of redundancy in the system that can be streamlined. One of the developments I've seen to address this is the emergence of what are called trust centers or exchanges, and they store these documents or artifacts, for easy confidential access to things like questionnaires that have already been filled out based on standard frameworks like NIST, COBIT, SANS, or SIG, created by shared assessments. And that not only makes it easy for a customer to audit you efficiently, but in the case of new business, you're able to clear those hurdles quickly. So it accelerates what we call time to sale. I mentioned already the role cyber and other risk ratings play, and we move beyond cyber now to categories like financial risk, ESG alignment. There are firms that are measuring firms along these other risk axes, and so it's not a complete solution by any means, but it's certainly more than a smoke detector, and gives you a way to triage your community to see which ones are deserving of more attention. I guess a third thing that I've seen, and let's face it, it's in the headlines all the time now, but artificial intelligence-driven engines that can parse through all these artifacts and quickly surface critical issues. So those are really 3 ways that we've really gotten at this really critical issue of what I call vendor fatigue.
Yeah, that's interesting, especially I guess it makes sense that you use AI engines to identify that information, especially when people are asking for huge reports and they're getting tons of reports as they select from 3 to 8 different vendors. Right.
It's sort of, tell me what I really need to know. The eyes quickly glaze over in this field.
Yeah. Those broader reports, just like audited financial statements or certain reports that show, financial strength or good system hygiene or protection, we found more are relying on those now as opposed to their own custom activities, which is certainly some relief. It just was untenable the direction things were going. Very manual, like you said, 500 unique questions every time.
Well, let's face it. I mean, there's just a mountain of work to be done. I think we're still in the early innings, even in the most mature vendor risk management programs today. And the only way we're going to scale to get this work done is to employ technology on a cost-effective basis. You can't throw enough bodies at the problem, or for that matter, find them to get the job done. And so technology really is playing an important role in addressing a very large and growing problem out there of vendor risk management.
Yeah. So whether it's vendors, it's banks, it's third parties, however you classify these, where do you see things going over the next 10 years? Where would you like things to go over the next 10 years? There's certainly growth in technology. There's a specialization, and if anything, there's more third parties. We use more technology third parties. Our data activity and footprint in our office is smaller. We use more services, and we're a tiny company compared to, the multi-tens of billion companies that are out there. And we're doing that. What's your vision for the future? Where do you see things moving to?
Oh, for one thing, I'm like a lot of people influenced by a book that Thomas Friedman wrote called The World is Flat. And it speaks to the dependencies that companies face when they rely on a growing number of interconnected third parties to get the job done. Now, a lot of the supply chain disruptions that we've seen over the last 5 to 7 years may result in work that had been done, say, in Asia coming to the US, but it's still a third-party connection regardless. And the way we think about that relationship really has to change and be much deeper and meaningful in order to achieve the goals of better security and alignment with other objectives to manage privacy, ESG, and other risks. So I think that the bias for horizontal organizations will continue. We've come a long way from Ford's vertically integrated River Rouge complex. And so, we need to think about these decisions about how vertically integrated we want to be in a more comprehensive way. It's almost as if that's determined by default today rather than some more high-level strategic objective that's sought. And so I firmly believe that we need to scrutinize third parties as intensively as a company might treat employees and job candidates. So that's to say that we have a chief HR officer, who worries about the performance aspects of those internal resources, if you will, through performance reviews, background checks, and the like. And also on the risk side, what's Joe's phishing click-through rate? How well does he score on security awareness tests? And how familiar is that person with our compliance requirements, as varied as that list is becoming today? So there's a lot of work involved on the internal side through HR today. And I want to turn that same level of scrutiny to our external resources, which, as I said before, I think we're just scratching the surface on today, even after 10 plus years of trying. Part of that comes from maybe thinking about the definition of third party in a different way. Traditionally, we're just thinking about our core vendors and suppliers, but there are a lot of other categories that really don't even get inventoried today. Outsourced service providers, SaaS apps like Salesforce.com and 50,000 others that are out there today that can be found in enterprise networks, cloud hosts, contractors, ecosystem partners. Think about, a technology firm that's bringing in a technology partner to get a certain aspect of their service delivered. Any security weaknesses in that partner is now going to get built into the product that the ecosystem partner was creating in the first place. And so you need to think about third parties in a more holistic manner, tier them appropriately based on measures like network connection, location of sensitive data, criticality to the business, and ease of migrating to an alternative if that's what's needed. But we also need to achieve a dramatic shift away from solely the CISO's responsibility in the case of cybersecurity or the data protection officer in the case of privacy, and create responsibility at the relationship owner's level. That's something that's especially important today among CISOs, as you're starting to see civil and even criminal liability for the CISO in the event of a breach. We've seen that in the case of Uber and SolarWinds recently. It's probably one of the most important things keeping CISOs up at night. And I think only until we reach, a true partnership between these advisory or functional experts like CISOs to the business owners of the relationship, we can make a truly informed, holistic decision about that third party's role with our organization, both from the standpoint of performance, how good a job are they doing it, as well as the risk. How risky are they? And footnote, there are no riskless third parties. So it's all relative, which underscores the need to make a balanced decision based on an assessment of both performance and risk at the relationship owner level.
Much of what we've talked about has been on the technology side, and the financial side exists. So if we look at banks as key partners, and they're certainly third parties, in terms of checking them for exposures to cyber, that's an area in an industry that's extremely well covered from all of the oversight that the banks have. But there's certainly some financial risk that people need to look at and manage. Counterparties, they might be the other side of some type of hedge that may last multiple years. You want to make sure that they're standing there. And so there's ways to look at them. Are they material? Like you said, are there tiers? Treasury looks at those, puts them in tiers, understands the level of exposure, and is that something they want to bear, or do they want to shift on that in some manner, both operationally and financial? When you think about this chief third-party officer and the overall third-party risk management, how do these come together? How do you get to the point where you're managing relationships? Is it still Treasury's managing? Do you think Treasury would still manage banks? Procurement would still manage some of the elements of supply chain. Another area would focus on another area, but this is a role that helps coordinate and leverage some of the tools, skill sets, and discipline, or what would that look like?
Well, I see the chief third-party officer, or CTPO, much like an orchestra leader. There's so many people doing so much work all on their own in silos that the key to this is going to involve someone at that level in an organization to really pull things together. And frankly, one of the reasons why I was so excited about coming onto this podcast, speaking to your audience of senior Treasury officers, among others, is that they get the need to look at risk in a multifaceted way. So while we've talked about the last 10 years of third-party risk management being so heavily, if not uniquely, focused on cyber risk, there are so many other types of risk out there. So you said when sizing up counterparty risk, this is a credit analysis, this is a financial viability analysis. You're starting to move into multiple categories of risk and developing a broader view of what that third party means to the organization.
Yeah, that's helpful. One of the things that's happening that moves towards that direction of this broader look, or horizontal look, if you will. You think about managing liquidity. Treasury's focused on that with the banks. There's certainly an interplay with AR and AP, other elements of the cash conversion cycle. And so people look at things like supply chain financing to have a bigger impact than just using the overall balance sheet alone, but some of the elements of the balance sheet to get liquidity. There's also the same types of discipline financially for counterparty risk in AR and AP done differently. And then cyber and some of the, I would call it the operational areas of the supply chain are done by different groups. So it's everyone's solving a bunch of similar problems and oftentimes using different tools. And this idea of the orchestra, had all of the instruments are making, woodwinds and brass, and they're all making different sounds, but they all have to play together. There's some overlap, right? They're doing it together in an organization. There's some overlap. I'm not sure where I was going with all that, but I like that idea of the orchestra because there's that difference and there's calibration.
Right. No, I think that there's a level of complexity in an orchestra that needs to be teased out. And just to give you an example, we've talked so much about third-party risk management, but every one of your third parties is dependent upon its own set of third parties, or what we call fourth-party risk management. And that's still in its early stages. The more regulated industries, not surprisingly, tend to be deeper in the scrutiny along fourth-party lines, and frankly beyond. But you mentioned, you made reference to supply chain, and that's got to be on the list of top 5 things a CEO has asked about in the past few years. And so all of this work in the third-party risk management area has extended into procurement in terms of a related category that I would call supply chain resilience. And so this is a question, maybe not so much for finance professionals, but certainly on the manufacturing side, there's a growing interest in tracking your suppliers and vendors, not just at the corporate level, but all the way down to the factory level, so that you can see your dependencies and vulnerabilities from a supply chain standpoint. Perhaps you might have, a reliance on one factory in a remote part of the world that is dependent upon certain shipping lanes to get it just in time to some assembly facility, without which, the line stops. And so you're looking at other risk categories in supply chain resilience that would include things like weather and logistics, something that has been compromised by climate change, wars, and the like. And so it's really a complex field, and we're just an industry sort of chipping away at it in pieces, and not to the level that we need to get in order to really get ahead of this mountainous problem.
Yeah, excellent. I know there's a few more avenues we could run down, but I wanted to give you an opportunity at the end to, do you have any additional or final comments to leave people with, either about the current situation or about how to think about the road ahead, or what to do, what to read, what to act upon?
Well, I would say, I think you have to be a glass half full kind of person in this business. The work that's being done needs to be elevated within the organization. That's why I'm a big proponent of this role I call CTPO, or Chief Third Party Officer, because it's not just, creating another C-level role, but serving as that, critical advocate that cuts across an organization in so many dimensions, be they performance-based or risk-oriented. And until you can pull all that together, you won't achieve the level of resilience that you need to be a world-class performer.
Thank you so much, Craig.
Thanks for having me. Enjoyed it.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.